Change. Good evening, friends. This is Subash Gangadharan. I'm a derivative analyst at HDFC Securities. Myself and my colleague Ajit Nayak, who's also a derivative analyst at HDFC Securities, will be talking about derivatives today. We'll be talking about all the basics of derivatives, the various terminologies that are used, and we'll also cover some basic strategies. So to start with, what are derivatives? Derivatives are basically a financial instrument whose value is derived from an underlying asset. So that asset could be an equity, it could be a forex or a commodity. And these instruments could be either exchange traded or over the counter. Today we will be discussing only about exchange traded contracts, which are futures and options. These future and option contracts are standardized and traded on the exchange. They offer high leverage and hedging possibilities. And we also have a load of data to understand the market sentiments. For example, indicators like IV, open interest, put call ratio, all these indicators are useful to analyze the derivative markets. So Ajit, could you please explain to us what are the various uses of derivatives?
Yeah, before digging deep into the other concepts of derivatives, we should know that why derivatives. And yeah, derivatives is definitely an edge over the cash market. But before that, we should understand what are the advantages and how can we use the advantages of derivatives. First, because the derivatives involves a low transaction cost when compared to the cash market, it has very low transaction cost. Second, because there is a spread between the futures and the cash market, we can the traders can have an opportunity of arbitrage trading opportunities. So we can look into an arbitrage trading opportunity. And the important most, everyone is looking for the leverage, the kind of leverage the derivative product has. It has a more edge over the cash market. So we can see that there is excess liquidity and leverage. And again, a trader can use as a hedging concept. We can hedge our own position, our portfolio with the help of the derivatives. These are the main reasons why derivatives are used. Now we know that the derivatives can use in a different ways, but before that we should understand who are the participants in a derivative markets. There are three most important participants. They are arbitrageurs, they are hedgers, and there are speculators. So who like arbitrageurs? Arbitrageurs are the person who take the advantage of the difference of the price between the spot market and the future market. Suppose the cash market is trading at discount. Suppose the SBI it is trading at 320 and the future is trading at 330. So there is a wide spread in the spot market as well as in the future market. So they can buy the cash and they can sell the future. But before doing this, they should understand the difference. It should be the cost involved should be less. Like suppose they are hedging, so there are other costs which is involved. So there should be a break even and they should earn something. So so there are high frequency trading going on to use this arbitrage opportunity. And there are hedgers. If you feel going forward 3 months down the line, the stock which are bought is going to have a correction or going through a bear market correction, then you can definitely hedge your position. The third is the speculators. The speculator plays a very, I feel the speculator plays a very important role because they generate the liquidity into the market. So these are the three major participants. Yeah, Subash, let us deep dive into the concept. Please explain what are futures.
Yeah, future contracts are basically an agreement between two parties to buy or sell an asset at a certain time in the future. Now, in order to create a position in the futures, a customer needs to put up a margin. And this margin will be charged on both the buy and sell position. So whether you're buying a future or you're shorting a future, you still have to pay a upfront margin. And on a daily basis, the exchange also calculates the mark-to-market margin, which is calculated depending on whether your position is making a loss or a profit. If there is a profit, then there is no additional margin calculated. Whereas if your position gets into a loss, then the exchange can ask you to put up additional margins. Now, what are the various terms that are used in the futures market? The first one is the spot price. This is the price at which an underlying asset is trading in the cash market. Then we have the futures price. The futures price is basically the price at which the futures contract is trading in the derivative markets. Then expiry date. This is basically the date on which the contract will expire. In the Indian F&O markets, it's usually on the last Thursday of the month. Then we have a concept called lot size. Each contract has a different lot size. For the Nifty, the lot size is 75, which basically means that when you buy one lot of Nifty, you are buying 75 shares of the Nifty. Let us look at an example. Mr. Sharma buys a contract on the exchange for 350 rupees, which entitles him to receive 100 shares of ABC Industries. Now, if the price moves up to 360 on the next day, he earns a profit of 10 rupees. If the price remains unchanged, then there is no profit and no loss. Conversely, if he has shorted the futures at 350 and the price goes down to 340, then he earns again a profit of 10 rupees. If it goes up to 360, then he makes a loss of 10 rupees on the short position. Now, Ajit, could you please explain the concept of open interest?
Yes. So Subash, open interest plays a very vital role when it comes to derivative markets. It gives a deep insight where actually the price is heading. So before understanding the application of it, let us understand what is open interest. Open interest is just the open contracts in the futures on an official exchange at any time. So how the open interest is created? Suppose I bought a contract and Subhash sold a contract. So the open interest for that day at that time would be 1. Suppose any other person, Amar, he buys 4 contract and another person sells 4 contract. Then the total open interest would be 4 plus 1. It would be 5. If suppose I was a buyer and I'm selling because I made a profit. Now I'm selling that futures. So the open interest will reduce, but it will not increase the open interest. So the number of players, the same players goes out of the market, the open interest decreases, and new players coming into the market, the open interest increases. So let us decode like how we can use the open interest for our benefit. So it is a very simple concept, but if we look, it will add an edge over our trading. So how it will help? So if the price increase with a raise in the open interest, it means we have a bullish outlook on the market. And if the price falls with the increase in the open interest, it means the market is going to fall ahead and it is in a form of correction. If suppose the open interest is decreasing and the price is rising, it means the short covering is happening in the market. And if the open interest is decreasing and the price is falling, it means the long liquidation is taking place in the market. Now we have if we focus on the short covering, there is also a concept called short squeeze. Most generally the short squeeze happen at the bottom of the market. It happens when the traders expect the price to fall. The market was already in a bear market, and even then the traders are expecting the price to fall, and suddenly there is an event or any positive news and suddenly they cover their short position. That time we can see a huge rally, a spike up in the price. So that is called short squeeze, and that is a great opportunity for the traders. And we can use our flagship product called the Pro Terminal. At the end of the session we will show how we can analyze the Pro Terminal, and you can see that various long build up, short covering, different types of position we can see with the help of Pro Terminals. Yeah, Subash, now let us see what are options. So can you please explain what are options?
An option is basically a financial derivative contract that represents a contract sold by one party to another party. The contract offers the buyer the right but not the obligation to buy a security at an agreed upon price during a specific time and on a specific date. So there are two types of options. There could be a call option and a put option. A call option gives you the right to buy an underlying asset, whereas a put option gives you the right to sell an asset. In the case of option buyer, you pay a premium to the exchange, and your risk is limited while the profits are unlimited. If you sell an option, you receive the premium, and your risk is unlimited while your profits are limited. Now, what are the various terms that are used in the options market? The first one is the option price. This is basically the price at which the option buyer pays to the option seller to buy the option. It's also referred to as option premium. Then we have a concept known as strike price. This is the predetermined level at which a specific contract can be bought or sold. So options have the same expiry date as the futures and also the same lot size. So if you have a bullish view, you should be buying a call option, or you can also sell a put option. If you have a bearish view on the market, then you are recommended to buy a put option, or you can sell a call option. Now, Ajit, could you explain more terms on the options market?
Yeah, there are three major terminologies which we need to understand before we enter into a trading arena. So the three important concepts are ITM, OTM, and ATM. So ITM means in the money call option, OTM means out of the money call options, and ATM means at the money call options. It is very important to understand these different strike prices, strikes of the options, because before trading you should understand which strike price you should bet on. So what does it mean? What does the ITM mean? ITM means in case of call option, the strike price will be less than the spot price. In case of put option, the strike price will be always greater than the spot price. Similarly, for the OTM, strike price is greater than the spot price, and for OTM put, strike price is always less than the spot price. And for the ATM, the strike price and the spot price will be at par. So we have shown with an like we can see with an example. So here, if Nifty is trading at 12,200, then 12,300 call will be OTM, 12,200 call will be ATM, and 12,100 call would be ITM. So once we know that there are different three terminologies, now the other important terminologies are intrinsic value and time value. The intrinsic value and the time value together together called as a premium. So for every call and put option, there is a premium which includes intrinsic value and time value. So what is intrinsic value? It is the difference between the strike price and the spot price. For call option, intrinsic value is underlying stock price minus the call strike price. So with the example, we can see for 12, if the 12,300 call is trading at 30 rupees, so the intrinsic value would be 0, and it will only left with the time value, that is 30. And for at the money, the intrinsic value would be 74 and would only left with the time value. And for the call in the money, there will be both intrinsic value and time value. So we have to keep in mind only for ITM options there will be intrinsic value, and remaining there will be no intrinsic value for OTM and ATM call options. So now what are the factors that affects the option pricing? So there are important 5 different factors. So one is strike prices. So the hence we have understood what is OTM, ITM and ATM. So the FAR OTMs and the OTM will always be priced lower when compared to the ATM and ITM call options or put option, vice versa. So when the call comes near to the OTM, the premium increases because the probability of reaching that strike would be always higher. Similarly, the stock price, if the stock prices increases, the price of the call option would increase, and if the stock prices decrease, the price of the put will be increased. Time to expiry. So this is time to expiry and volatility. These are the major, these plays a major factor on pricing of the option, because every product of call and put both has a definite time value. Like to just to say, for a monthly call option there would be around 20 days, so and weekly there would be 7 days. So at any given point of time, the weekly call option would always be cheaper than the monthly call option of the same strike price. What I mean to say is 12,300 weekly option and 12,300 monthly option. The weekly option will be always be cheaper because it has less time value compared to the monthly option. Similarly, volatility. Volatility is a factor which it is very difficult to incorporate while calculating the option price, because what is volatility? Volatility is a range for that day. So we cannot expect the volatility, we cannot forecast the volatility with the accuracy. Today it might be just 1% and tomorrow because of some news it can go up to 3%. So incorporating volatility is very difficult, but it plays a very important role. The higher the volatility, the higher the opportunity one can make money, and that is why the price of the option with the higher volatility is always at a premium. Because let us take an example. If person A want to reach from A to B with the help of a cycle, and person B wants to reach to A to B with the help of a motorcycle, definitely the person with the motorcycle will reach to B in a very less time. That is why it is charged a premium. Now Subash will explain with the help of the example what is call option and what is put option.
Yeah, we have an example of a call option buying strategy. We are buying ABC at 500 strike price at rupees 4. We are buying this call option because we are bullish on the stock and we expect the stock to close above 500 before expiry. So the break-even point of this strategy is the strike price, which is 500, and plus the premium, which is 4 rupees. So 500 plus 4 is 504. So profits will come from this strategy once the price crosses 504. Risk is limited to 4 rupees as this is the premium and we can't lose more than the premium. The reward is unlimited as options give you unlimited upside. Now there's also an example of a put option. We buy a put option if we are bearish on the stock. So in this example, we are buying ABC 500 strike price at 4 rupees. The break-even point for this strategy is the strike price minus the premium, which is 500 minus 4, which means that the break-even is 496. And one can make profits once the stock falls below 496. So risk again is limited to the premium, which is 4 rupees, and the reward is unlimited. Now, what to do and what not to do. So this is important to know to successfully trade in the markets. So one very important thing is do not put all your money in one position. It is best to diversify your positions. At least minimum 3 positions you should diversify. You should also identify your risk reward ratio. Ideally, your reward should be at least 2 times your risk. If it is less than 2, then it is better not to take the trade. It's also important to follow a disciplined strategy by maintaining a stop loss or hedging your positions. Be thorough of the concept that you're trading. It could be either buying on supports or buying a breakout. Whatever concept you're trading, trade it consistently and research properly, or take the help of the research team at HDFC Securities. Do not work on anonymous tips or without research consultation, and do not take high risk with limited reward. Also, do not take more exposure if you are not able to pay the mark-to-market margins. It's better to make lower profits consistently than taking big risks and losing your capital. Now, how do you trade with us? You can visit our website hdfcsec.com, or you can download our mobile app and trade on your mobile. And you could also subscribe to our Pro Terminal package, which helps you to make trades in the market. So with that, we conclude our presentation today, and we'll be back on Saturday with our advanced derivatives module. So till then, goodbye and happy trading.